Welcome to All Things Finance. Today, I will be talking about the basic concepts of bond market. In this video, you are expected to learn the following. What is a bond market? What is a bond? The different types of bond market securities, the characteristics that differentiate bonds with each other, and the risks that are faced by an investor of bonds. So what is a bond market? The bond market, often called the debt market, fixed income market, or credit market, is a collective name given to all trades and issues of debt securities. Governments and corporations typically issue bonds in order to raise capital to pay down debts or fund infrastructural improvements. So what is a bond? A bond is a long-term debt security issued by a government or corporation. It has a maturity period of 10 to 30 years. It is basically a long-term loan granted to a corporation or government by an investor. By issuing a bond, a company or government borrows money from an investor. In return, the investor earns interest of the money they have loaned. The interest, also called as coupon, is paid periodically, such as annually or semi-annually. The investor is also paid the principal of the bond at maturity. Companies frequently issue bonds in order to finance business expansion projects, to fund entirely new projects, and/or maintain ongoing operations. So what are the different types of bonds? The first type of bond is called a treasury bond. A treasury bond is also known as government bonds. They are issued by the Treasury Department of the government. Treasury bonds are used to set the rates for all long-term fixed-rate bonds. The Treasury sells them at an auction to fund the operations of the government. They are also resold on the secondary market, and they are the safest since they are guaranteed by the government. That means they also offer the lowest return. The second type of bond is the savings bond. Savings bonds are also issued by the Treasury but can be purchased from many financial institutions. They are attractive to small investors because they can be purchased with as little as $25, but larger denominations are also available. Savings bonds has a maturity of 30 years and has no secondary market. Savings bonds can be redeemed at any time before maturity, but after 12 months, but with a penalty. The third type of bond is a municipal bond. It is also called muni bonds. It is issued by states, cities, municipalities, and other government-owned entities in order to raise cash to fund various projects. The fourth type of bond is a corporate bond. Corporate bonds are long-term debt securities issued by corporations that promises the owner coupon payment interests on a semi-annual basis. The minimum denomination is $1,000 and the maturity is typically between 10 and 30 years. The interest paid by the issuer is tax deductible. Corporate bonds can be described in different characteristics. But first, let me introduce to you bond indenture. Bond indenture is the contract between the issuer and the bondholder. It specifies the following: the details regarding the payment terms, collateral, if any, the positive and negative covenants, par or face value, which is usually at increments of $1,000, and bond pricing, which is a percentage of the face value. Some of the characteristics that differentiate bond with each other are the following: the sinking fund provision. Sinking fund provision is a requirement that the firm retire a certain amount of the bond each year. This is considered an advantage to the bondholder because it reduces the risk of default. An example would be a 20-year bond that has a provision to retire 5% of the bond each year. The second characteristic that differentiates bonds with each other are protective covenants. Protective covenants are restrictions to the issuing firm that are designed to protect the bondholders from being exposed to risk during the investment period. An example is a limitation of the firm on giving dividends and corporate officer salaries during the term of the bond. Second is the restriction of the firm on acquiring additional debt. The third characteristic of a bond that differentiates them from each other is called a call provision. Call provision are provisions that allows the firm to call the bonds. A call provision usually requires the firm to pay a price above par value when it calls its bond. The difference between the bond call price and the bond par value is called call premium. Call provisions has two main uses. It gives the firm an option to call the bonds when there is a decline in interest rates after the issuance of the bond. In this way, the firm can issue a new bond with lower rates. Number 2, call provision may be used to retire the bonds the same as how a sinking fund provision would function. The fourth characteristic is a bond collateral. A collateral is a security deposit provided by the issuer to the bondholder. Its aim is to reduce the risk. The different kinds of bonds according to the collateral are mortgage-backed bonds, secured by real estate properties, chattel mortgage bonds that are backed by personal properties. First mortgage bonds are bonds that has first claim on assets secured. Debentures are bonds that are not secured, and subordinated debentures. These are bonds that have claims that are secondary to the claims of a debenture. The fifth characteristic is the low and zero coupon bond. Low or zero coupon bond are long-term debt securities that are issued at a deep discount from par value. They are essentially invested for tax-exempt purposes. The sixth characteristic is a variable rate bond. It is also called a floating rate bond. The interest rate of these bonds changes periodically. The coupon rate is usually pegged at LIBOR or the London Interbank Offered Rate. The seventh characteristic is its convertibility. The bonds with convertibility features are called convertible bonds. This allows bondholders to convert the bonds to common shareholders. Because of this feature, bondholders are willing to accept lower interest rates. Of course, like any investment, bonds are not without risk. One risk that bond investors face is the possibility that the issuer defaults in paying back the principal. This is what is known as default risk. Typically, bonds with higher default risk comes with higher coupon rates, while those with lower default risk comes with lower coupon rates. The amount of risk depends mostly on the financial stability of the issuer. For example, most governments are generally considered stable issuers and issue bonds with low coupon rate. Corporate bonds typically represents a greater risk of default as companies can go bankrupt. That's why corporate bonds often offer a higher coupon rate. Several credit rating agencies assign rankings to different bonds. This can help the bond investor gauge the financial strength of the issuer. These rating agencies often use different criteria for measuring risk, so it is a good idea to compare ratings. Another risk to consider is interest rate risk. This is the risk that interest rates will go up and any bonds you own will be worth less if sold before the maturity date. After all, when interest rates rise, more investors allocate their money into the newer, higher interest rates. If you wanted to unload a low interest rate, you will have to sell your bonds at a discount to make it a worthwhile purchase for another investor. To sum up this lesson, consider this scenario. A corporation is planning to expand its business and decided to issue bonds. Each bond is a loan for $1,000, which A corporation promises to pay back in 10 years. And to make it more attractive to investors, promises to pay 5% coupon rate annually. Here, an investor buys the bond at a face value for $1,000. Now let's fast forward. Each year, the corporation pays the investor $50 as coupon. These regular interest rates continue for the length of the bond, which is 10 years. Once the bond reaches maturity or on year 10, the investor redeems his bond and A corporation returns the $1,000 principal investment. This bond was a good deal for both the corporation and the investor. Corporation got the money it needed to expand, and the investor received regular interest payments plus the return of his principal investment. Because a bond offers regularly scheduled payments and the return of invested principal, bonds are often viewed as a predictable and more stable form of investing. So, would you invest in a bond? Comment your responses down below. Thank you so much for listening. If you enjoyed this video, please click subscribe, like, and share to anyone who are interested in investing bonds. Thank you so much once again and have a great day.